It's 6 o'clock in London, it's 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, wherever you are in the world today. My name is Patrick L. Young. The IPO-VID live stream, Series 14, Episode 3, that gets us to episode number 81, starts here. So, just a couple of months ago, nobody had ever heard of the concept of Dutch title transfer facility unless you were a hardened gas trader, and now it's the name on everybody's lips when they're in Brussels, fresh from inaccurately accusing the Dutch TTF of being an inaccurate benchmark in its own right. The EU's panjandrums, led by President Ursula von der Leyen, are suggesting a price cap on the ICE-traded benchmark. What could possibly go wrong with an open market plus a one-way government-controlled price? Meanwhile, the UK Conservative Party appears to be on the cusp of suicidal implosion. There's no other word for it. But there's still time to properly deliver the bonfire of EU red tape to help Britain make Brexit a success, argues IPO-VID alumnus Barney Reynolds in his latest op-ed piece in the Sunday Telegraph last weekend. Here's hoping the UK government can make that a reality. Other things that became a reality in the course of the last week. Well, UK clearinghouses, they passed their tests last week, albeit the LME had a close shave of near capital depletion in the simulation stress test, despite doubling reserves after the nickel nightmare. Over in Australia, the ASX, the Australian Securities Exchange Group, is coming under pressure to relinquish its monopoly control over clearing and settlement in the interests of competition, reducing conflicts of interest, having failed for years to implement a digital asset replacement for the ASX's aged CHESS system. And in Switzerland, very interesting things may be afoot. Credit Suisse is seeking to sell some or all of its 6 group shares, and that makes for a cornucopia of complicated possible outcomes, as covered already in Exchange Invest, the daily bulletin of the Bourse business. Our guest today, ladies and gentlemen, is Mack Gill. The topic is delivering new Parish technology. Mack is the COO and a board member of Torstone Technology, a leading global post-trade technology company for financial markets. Mack is also Director of Yaala Labs, a next-generation market infrastructure technology company. He was formerly CEO of MillenniumIT, an industry-leading global capital markets software company, which, of course, is the IT technology matching engine arm and more of the London Stock Exchange Group. Prior to that, Mack was president of SunGard Technology Services. Gosh, there are many more things I could say about this incredible 25-year career, but actually, Mack, let's just get into the discussion. Hello, good evening, welcome. Where in the world are you today?
Hi, Patrick. Great to see you, and thank you so much for having me on today. I'm here in the city in London, where I'm based, and actually, I made sure I sat in front of a picture here, which to give you a little view, I'm sure some of you folks would recognize that. But I'm actually not too far from there as we speak. So as you say in your intro, lots to talk about in the UK right now, and lots to talk about in the industry. I was pleased that you actually talked about ASX there and the CHESS project, because again, there's no good coverage these days of the industry without talking about post-trade, right? I'm sure we'll be talking a lot about post-trade here over the next hour or so. But great to be here. Thank you.
You're very, very welcome. It's a delight to see you coming live from the City of London. I'm glad to see that we've both got electricity, because indeed I must apologise. You were supposed to be our guest on episode 70, but that was somewhat abridged when suddenly Malta found itself bereft of electricity on that particular occasion due to, well, an excess of summer sun and clearly a lack of solar power. There's an interesting conundrum for us all. We don't need to be Greta Thunberg to work out that that doesn't seem like a very logical concept. Now, Mack, I mean, the title of today's show, we're talking about the idea of delivering new Parish technology. And obviously, you have got an incredibly long history on the tech side. But tell us a little bit about it. I mean, where did you begin? Because I sense that hint of a Canadian accent.
Yeah, I haven't lived in Canada for an awfully long time, but the longer that I'm out of Canada, the more that I miss it. And I was like meeting other Canadians, out there in the world. There are a lot of us, even here in the UK. Mark Carney being a very good example. But yeah, I grew up in Canada, and but gravitated over time to New York, like a lot of Canadians actually, and started my career in financial technology there. And actually, counting the years, it was a long time ago, back in the BlackBerry era, or even early BlackBerry era. And I had the opportunity to kick off my career in financial technology. We didn't call it fintech, obviously back then, but really in the OTC and the risk space back in the mid '90s, working with SunGard, and the company I joined. I actually had the real opportunity, amazing opportunity to work with Chris Conde, who was running a big part of SunGard at that time in the OTC, and derivatives and risk space. And that that market back in the mid '90s was incredibly interesting, as it was moving, as many asset classes and many markets have done through, from the the '70s onwards, moving increasingly electronic, moving increasingly towards automation, towards more sophisticated technology solutions, getting beyond Excel. And so we had a tremendous time in the '90s, working with new technology, bringing together solutions to better price. And actually, there we go, Patrick. We talked about power going off in England. There we go. Hopefully that works okay.
We can see you.
Yeah. Okay. So working with new technology in that space was really a great way to start my career, actually, and went on from there. So that was the initial challenge. Although SunGard, as we grew, added a whole bunch of, through acquisition, we added a whole range of technology companies and solutions across asset classes, across geographies, and again, we had a really interesting time in the 2000s, bringing together and integrating solutions, and that really was the name of the game in the 2000s. And then 2008 changed a lot of things, but we certainly had a strong vision for integrated technology solutions across asset classes. So that was really where I cut my teeth, if you will, in the in the technology space.
That's a fascinating career arc altogether. We're going to get back to it in just a moment. And let me say, first of all, actually, good evening, Les Calvert. Evening, Patrick, and all Les is saying. Great to see you this evening, Les. Thank you very much for your message. If you've got a question, or anybody else who's lurking, watching at the moment has got a question for our guest this evening, Mack Gill, we're talking about delivering new technology. And I think it's going to be a fascinating opportunity to talk all around the parish of exchanges and indeed OTC markets. And I mean, Mack, it is so interesting when you talk about it. I mean, coming out of the OTC markets in the 1990s, which just seemed like such a go-go irresistible juggernaut. And actually, they did have quite good technology spend, which was something that wasn't necessarily true of a large amount of other areas of the markets where people really wanted cheaper commoditized packaging. And it is fascinating how you saw that amazing dynamic. You had all of those pointy-headed, super mathematical French people who came in and developed systems and so on, and they all ended up in these multinational operations. And indeed, how those markets were shaped by such fascinating characters, such as indeed, as you say, Chris Conde.
Yeah, I mean, it really, I think it was a unique period, given, again, bringing new technology to a market that was growing tremendously, adding a lot of value, obviously, and there was obviously a lot of opportunity for institutions in there. But it was an incredible confluence of mathematical expertise, and you mentioned obviously a lot of amazing people from the French market, but all over the world, but also really the best of the time of Silicon Valley. And there were a lot of companies. We bought a company called Renaissance, which was a phenomenal Opus product, which I run across people in the industry that still used Opus, or used Opus back in the 90s and still rave about it. It was a real next step into object-oriented programming, and very incredibly user friendly. from that perspective. We also bought Infinity, and it was an incredible mix of talent that really, to me, has been, I think, the tremendous thing about being in this industry all the way along is that you have the best from technology, the technology industry, along with incredibly strong quantitative people, and that's really, I think, where the magic happens in this industry is when you have not siloed expertise, but bringing people together across these two incredibly dynamic industries into financial technology. And so again, I feel very privileged to have got into it when I did, and also in such a dynamic space. And of course, we've seen these waves of innovation and waves of technology coming through asset classes and markets. That certainly was one major wave. We've seen so many more through the subsequent years, and now obviously the last 10 years have been incredible. And I'm sure we'll talk about all the latest markets and trends on that from that perspective. But really, I look back very fondly with into those early days.
Well, it's very interesting because you think about those days, and I mean, people think about the idea that technology, and particularly fintech startups, were a totally new thing. And yet actually through the late 80s, right through the 90s, you had these very intrepid fintech startups, they would be called these days, because they really did start picking up a particular product. And you've mentioned a couple of very interesting products there with Infinity, Renaissance. If you think about the OTC options business, where Phoenix came in and went from nothing to being ubiquitous across the entire market, yet was an entirely independent operation to start with. And I think a lot of people don't really realize that back in the days when even the 286 processor was just giving way to the 386 processor, let alone the 486, that there was actually a huge amount of innovation on the technology side and an incredible number of very, very interesting entrepreneurial types who were running around the marketplace.
Yeah, no, absolutely. And the and that's just continued along the way. But again, it's all about barriers to entry, right? And the barriers I think were low in that period. I think they've gone up in certain areas since then. But I think one thing we've seen all the way through, I've seen certainly in the last almost 30 years I've been in this business, is the constant, the attraction to this market, to the financial markets. And again, with each wave, the interesting thing is with each new wave of underlying infrastructure, you have the opportunity to come in and do something better, faster, cheaper. So, you have obviously going all the way back to the mainframe and batch era. We go into the client server space. We talk about object-oriented programming. We've been talking about DLT. Each new wave provides, again, lowering of the barriers of entry, and I think that's what keeps the dynamic alive. And each new wave really kind of rejuvenates, and also obviously brings in a younger generation of people. But that's what keeps this industry incredibly dynamic. Then of course you talk about the whole the dynamic between startups and scale. You have large organizations, and that's that it's a challenge to take a good idea and actually scale it in this industry as well. So unfortunately, a lot of great ideas don't get very far, but you have to really be able to scale as well.
It's interesting actually, because you talk about apologies for that, ladies and gentlemen. We just had a slight technical kerfuffle. We're just talking about generations of technology, and here we are thinking smugly that we can all manage to easily broadcast across the interweb, when actually it's not the case necessarily. I'm not quite sure what happened there. I do believe it was a studio production software problem, because I know that at least one, if not a couple, of the production's crew were thrown out. Glad to see that you're all back in there. Apologies for that, Mack, if we left you all alone. I'm not sure if we left you behind. We're talking about generations of technology and barriers to entry. And actually, I'm quite fascinated with that, because the one thing I do think is different is that in the 80s, 90s, a lot of the barriers to entry were actually convincing mostly very analog people that they needed to use this technology for whatever purpose. Whereas now it's really become a lot more sophisticated because you've got huge amounts of audit risk. People demand that your balance sheet is substantial enough that you can take a hit, so therefore you will continue to supply the software. And then of course you have a huge incumbency problem because there are massive backbones of technology which may already exist within, say, banks or exchanges, which may not take very pleasantly to the idea of you overlaying or enhancing or adding your particular product.
Well, I think it depends on, there are different ways of looking at it. I think one thing that has changed tremendously in the past even 5 years is the advent of cloud. And what I mean by that is that these days when you have a SaaS solution and you're able to use a global platform like AWS or Azure or Google, once you're onboarded, you immediately have the global scale that a large financial technology organization has and has spent decades investing in, and has sunk an awful lot of capex into it, and also has a lot of ongoing opex just to manage their estate. You can really leapfrog that these days with a SaaS platform. And again, it's much easier, if you're on AWS, to sell into an organization with all the certifications and security that comes along with AWS. So that I think actually has been a game changer in terms of barriers to entry, or certainly barriers to scale over the last 5 years. And again, 5 or 6, 7 years ago, it was selling cloud into large financial institutions was you were knocking your head against the wall. But that's absolutely changed. Even pre-COVID, that was moving pretty quickly. Post-COVID, the industry has really been shifting quickly, and so I do think there is that has leveled the playing field for smaller organizations. But taking a step back from that, even it really depends on what part of the financial market landscape you're talking about, because if you look at front office or even risk, there's budget and there's an appetite for new bells and whistles, and there's an appetite to check out new solutions, because it's really kind of it can be on the periphery in terms of the sandbox for pricing for risk. When you talk about core processing, middle office and back office, that's an entirely different ballgame. And the barriers to entry into that space are huge because of the compliance requirements. I mean, just the simple need of the complexities of providing a full, post-trade operation with all the workflow involved. It's very, very difficult to break into that space. And actually, I've been very fortunate with being part of the group Torstone technology that I'm with now, because we have a full middle and back office platform. And the reason we were able to get into this space is we were actually developed in-house at a bank initially, KBC Financial Products, which was a global investment bank, a sub of KBC. But the investment bank was based in London, and it had global operations in New York, Hong Kong, Tokyo, etc. And the team there decided that they were on a legacy post-trade platform. It wasn't scaling. Certainly wasn't cross-asset or global. And so they had a vision of building their own. And so they started off first principles approach in the 2000s, and started developing a very forward-looking platform for their own business. And they did get it live for their global operations right before 2008. And unfortunately, through the GFC, the organization had some challenges, nothing to do with their post-trade platform. And through that, over the course of a couple of years, we're able to accomplish an MBO of the platform, of the IP. And so the core team came out of the bank and created Torstone, actually 10 years ago, back in 2012. And so they were then in the market with a post-trade platform. But again, it had taken more than 10 years of investment by the bank, and significant investment by the bank over those years, to create the platform. And so and obviously we've continued to invest in everything since then. But the barriers to entry into post-trade are phenomenally high because of, again, the you don't get 5 people going off in a garage and spending 2 or 3 years and coming out of it and convincing a bank or a financial institution to migrate onto their platform. That model just doesn't exist. There's no VC for that, for that model. So it's interesting, compared to the front office, the post-trade side of things hasn't had as much new competition in this space, and the market is very much dominated by a couple of large global players that have been around for a while. One of them, obviously, I spent a lot of time at least in an earlier incarnation of that company, but so it's just interesting. The dynamics really depend on the part of the market and again, the underlying technology.
So it's quite fascinating, and actually that feeds in very well to a comment we're going to have in just a second. An interesting question from Michael Grekoff. Let me just say good evening to Marcus Ward. Lovely to see you this evening. Thank you very much for your question, for your comment. And here we have Michael Grekoff offering, wow, quite an extensive question that we're going to enjoy delving into. So, Mack, will markets that don't have near-term plans to get to real-time post-trade functionality lose out to ones that did or will soon? Should post-trade services hold individual accounts at the CCP level to achieve the full efficiency benefit, as well as the benefit to manage market integrity at a higher standard?
That's such a great question. I think the first part of the question, I think we could dig into so deeply. We look at so much of our markets right now are still run on batch processing. And there's so much risk, vast unsecured risk associated with these daily batch processing operations that we have across the industry. And I think that there's so much the industry can do to move away from that, to moving towards really a real-time paradigm. Because absolutely, the question, I think there's markets that are real time. Liquidity will flow to real-time environments, and we've spent decades talking about real-time matching. I mean, look, when I worked with the team at MillenniumIT, the LSEG, I mean, at that time we had the fastest matching engine in the market, and it gave us a tremendous advantage. And you're fighting for microseconds. But the irony is that, again, you get into the post-trade side of things, and different asset classes and different markets are on not even T+2. We're talking multi-days in some cases for the full process. And so I do think that when we have any market that has that faster, more real-time approach, is just going to inevitably attract liquidity, lower risk, lower margin, and everything else. And that actually is what got me involved and really attracted to the post-trade side of the industry back 5 years ago when I joined Torstone. Because when I was at Millennium, we had, again, a phenomenal trading platform. And I'm sure many of you listening are very familiar with the Millennium platform. But we also had, we've extended that into the CSD and CCP space. And one of our biggest clients being LCH, and that was a tremendous adventure. I'm very, very proud of that project continuing, and that platform adding a lot of value to LCH in the equity clear business. But seeing the importance to market infrastructure, or to post-trade market infrastructure, of real-time intraday capability, absolutely got me fired up about the need for the wider sell-side environment. Because it's one thing for market infrastructure to be, to have, weapons-grade real-time technology, but it's a tremendous challenge and opportunity for sell-side institutions to map to that and to be managing, their flow, managing their exposure, in a similar fashion. And again, so many large sell-side institutions are still on batch processing, on legacy. There's still mainframes out there. There's still a lot of older systems, and I'm everything that we're seeing in the market right now is just it's just screaming at us that we have the opportunity and the challenge and the need to to modernize our state and do that for so many good reasons. And then it's been the last 5 years have been tremendous, in terms of my vantage point on that. And I'm convinced that the next 5 years are going to be even more exciting because there's so much going on with regulatory change, with the move to shorter settlement cycles in North America right now, and inevitably everywhere else. Obviously, crypto, everything that represents with same-day settlement and all the dynamics of that market and everything else that's going on. So, post-trade, for a lot of my career, was not where the action was, to be honest, in terms of technology or people looking at bringing real change to the industry. But that has absolutely changed in the last 5 years, and that's phenomenal. I think that's again, there's so much technology and operational business change that we're going to see in the next while. So it's but back to the question. I'm sorry, I kind of digressed on that. It got me excited thinking about the whole real time angle. But
it's very interesting. I mean, you talk about the real-time angle, and certainly that's something I think a lot of people don't talk about, because certainly you think about T+2 days, or you think about batch trade. I mean, batch settlement happening daily, and that's 86,400 seconds of risk. And you look at that and you suddenly start to think about what our markets are. And we don't need to be in the markets where they're trading umpteen zillion times per second with the kind of messaging that, yes, you helped develop it at Millennium for LSEG, but nonetheless, you think about the crises that we've had over time. I mean, you think about Hanmag in South Korea, where famously there was a proprietary trading company there, Hanmag, and it had a $20 million balance sheet. It went to minus $25 million because an algo went wrong in 143 seconds. And no batch is going to manage to help you with that on any front in risk or anything else. And in fact, a lot of the people who come in now say, oh, yes, but of course, if it had been on the right blockchain, it would all been better. Well, it might have been, but on the other hand, the Bitcoin blockchain's taking, 400 seconds to settle. So Hanmag could have still happened 2.5 times over without a problem. And it is very interesting because there's a huge opportunity to really tighten up risk there, which is quite phenomenal. And actually, I'd love to get you back to the second part of this question from Michael. Really, it was 2 questions from Michael Grecoff, because I think you answered the first one beautifully. But do you think that post-trade services should be holding individual accounts at the CCP level to achieve the full efficiency benefit, as well as the benefit to manage market integrity at a higher standard?
Well, look, I mean, I think integrity is that obviously when you're holding individual accounts, I mean, you have direct skin in the game, and that's, you can't argue with that benefit. But at the same time, when you're managing a CCP and managing overall risk and liquidity, I mean, the benefits of aggregation and everything else that comes with that, as a business model, I think are they're huge. So I think you have to balance that out, both in terms of from a regulatory perspective, what might be best, versus being able to have a viable business at a CCP level. So I think, and I hate to say that it depends. I think it depends a little bit on the maturity of the market and what exactly we're talking about from an asset class perspective and everything else. So it's a balance to be made.
Hashtag it's complicated, like so many of these things in the clearing and settlement world, as we're trying to get so much, but certainly we're in heated agreement. There's a huge opportunity there. Thank you very much, Michael Grecoff. That's an absolutely phenomenal question altogether. If you've got a question for Matt Gill, as we're talking about delivering Parish technology around the world, then do please send us a message, whether you're watching us on Facebook, LinkedIn, or YouTube this evening. So Mac, I mean, going back with Torstone, so Torstone is really very much, if I get it right, a sell-side focused company?
Yeah, no, absolutely. So we're focused on sell-side banks and brokers, and again in a market that really has a need to modernize. And so what we have is a SaaS platform entirely deployed on AWS. So I mean, it's amazing it's such a huge market. If you look at all the many thousands of sell sides around the world, and yet there's so few large players in this space. We have 2 very large companies out there that frankly dominate a large majority of the global sell side. And again, I guess for the reasons I talked about earlier, very few new entrants. And so we're excited to be one of those. We're not exactly brand new, but we're certainly emerging. And I think that the ability to deploy globally on AWS certainly has given us amazing rocket fuel for people that are looking to take their operations to the cloud. And again, it used to be 5 years ago, trying to convince a bank to put their books and records, their post-trade operations on AWS was a hard sell, but now it's totally shifted. But the other interesting things that we bring to bear is that we're cross-asset and we're global, by design in terms of our data model, in terms of how we can deploy. So most of the solutions that we come up against, either legacy vendor or in-house, are incredibly siloed by asset class, by legal entity, by geography. And so the opportunity for the sell side to consolidate operations is phenomenal. This is the most incredibly siloed part of the industry. And so that's the journey that we're on, is working with sell side institutions that want to consolidate, that want to modernize, want to digitalize, all of these things. And again, there's a lot of waves that are coming at us. And I think the settlement cycle wave in North America right now, with moving to T1, is one massive change that I think, it's not news. The industry's been talking about it for the past 9 months plus. But I'm not sure everybody, especially in smaller organizations, have really realized what a massive change this will be. It's not, there were earlier moves from a T+3 settlement cycle to a T+2 settlement cycle where, add a bit of automation and people got the job done. But it requires a wholesale change to how you're managing your estate, your operations, how you're looking at stock lending, how you're doing with, your FX. It's every sell side organization is going to have to spend a lot of time and energy on this over the next 2 years, and it really is a massive regulatory driven change in this industry. And for those of you that are sitting in Europe or Asia, of course it impacts you as well, because everybody has some US flow, and in actual fact it's going to be in a T1 North America cycle, it's going to be even more challenging for you in Europe, and even more challenging for you in Asia, given time zones, to be able to to manage your operations within that. And in Asia, it's going to require a lot of pre-funding just in order to be able to manage within your time zone cycle, and somewhat less in Europe, but still it's going to require the entire industry to look at this. I just got back. I spent last week at Sibos in Amsterdam. It was the first Swift Sibos meeting in 3 years, and for the securities community at Sibos, T+1 was very, very much the big focus, and I think people are understanding that now. But I still think that the penny hasn't fully dropped in terms of the sea change that this represents. Across, this isn't just, it's not a technology issue. It's not an operational issue. It's not a funding issue. It's not a stock lending issue. It's everything. So I think as an industry, we'll be talking a lot about this, and not just the folks that are in post trade. It'll affect the front office as well in a big way. But so it's a big change coming to the industry, and frankly, very welcome for those of us that want to see more efficiencies and want to see the industry, get on with things, right? I think I'm constantly frustrated by the increasing delta of our operating environment in our industry compared to the rest of the world moving on with contemporary software, contemporary technology. I'm not talking about the digital asset side of things. We can come back to that. That's obviously a different animal. And be really interesting to see it as we get convergence with digital assets and traditional finance. But this industry at the core needs to get way more efficient over the next 3 years. That's just the absolute challenge and opportunity.
Yes, it's quite fascinating how that's going to upend so much of the business per se. And I suppose actually that's possibly a good time though to just talk about moving alongside Torstone. I mean, I mentioned at the start, you're on the board of Yaala Labs. Tell us a little bit about Yaala, how that works.
Yeah, no, I'm very excited about this. I've been on the board of Yaala for a few years now, and Yaala is it's a group of colleagues of mine that here we go. The London, hold on a second. The London power outage is hitting again. Let's see if that goes. Oh well, pardon me. This is my turn for the lights to come off. So the Yaala team is a group of people that actually were my colleagues back at MillenniumIT, and some incredibly talented people, including our CTO, our chief architect at the time, one of our business leads, one of our heads of sales, and the group came together really wanting to take everything that Millennium represents in terms of market standard and pedigree and everything else in terms of latency and resilience and everything else, but rebuild or recreate and bring to market something that's really cloud native and built for the digital age. And that was the journey that they started on, I guess around 4+ years ago. And they've been very much heads down building a new platform that for digital asset marketplaces, but also for traditional asset or traditional asset classes that want to leverage new technology. And so they started off working with some of the large crypto exchanges. They actually worked on one of the futures matching engines for one of the largest crypto exchanges in the world. And they've gone on to work with a range of other folks, and as they've been building out their platform, and they've actually just taken live a very interesting, very exciting new marketplace called LedgerEdge, which is a corporate bond market, DLT-based corporate bond market that's backed by David Rutter, and he was also obviously working with R3. And so that LedgerEdge is a phenomenal relationship for Yaala Labs. They've been working together. LedgerEdge is now live on that platform and bringing a lot of new business models in terms of how they manage both a central and a distributed order book to the corporate bond market. It's a $40 trillion market that really needs some new solutions and new technology. So that group with Yaala is incredibly exciting in terms of the pedigree and the experience, and also though being cloud or digitally native with and working with all the latest infrastructure. So I think that we'll see a lot more from the Yaala team as they work not just in traditional markets, but also some really interesting new markets. They're working with a new NFT marketplace. They're working with some securitized tokens and everything else. So it comes back a little bit to the point we talked about at the outset about the new waves of startups, new waves of talent coming to market and being enabled by new architecture and new platforms. And that's the wave that we're seeing now. And I think that the folks in the team at Yaala Labs are really leading that, bringing together real expertise in financial market technology, but with truly digitally native. So it's a group that I'm tremendously excited about.
So that's very interesting. So Yaala is digitally native. It's it works with legacy financial products, but also works with blockchains. It's presumably blockchain agnostic, and it is an execution matching engine. And what other suite of products are in there?
The focus, the platform is called P8, and the focus really has been on matching, but really just like the Millennium platform, where the core technology was extended to pre-trade and post-trade, with its anchor in matching. It's a similar approach in terms of having a full marketplace being enabled by the P8 platform. And so, over time, that will just continue to extend. But really is, for people that are looking at a new marketplace, and there are all kinds of interesting marketplaces, as you know, because you talk a lot about that and give a lot of great coverage to new initiatives in this industry. but people that are wanting to trade carbon, people that are wanting to trade new asset class, whether it's digital or traditional, going to an established vendor and having to have the heavy lifting of working with a platform that brings a lot of infrastructure, a lot of cost, isn't necessarily always the right decision. And so this is, if being able to work with a lighter touch, with again be a full digital native infrastructure, is something that but wanting to also support a full marketplace is something that the Yaala Labs team is all about. And again, that's been the partnership with LedgerEdge, and again, phenomenal new business model into an existing market that really is crying out for new technology, new solutions. And there's so many asset classes and markets are in the same boat. So I think the next, in the years ahead, we're going to see a lot of, again, every day it seems like a new digital asset type market popping up. I'm sure the majority will fail. Some will be incredibly successful. However, there's also the chance to rejuvenate and revitalize existing marketplaces that that can really leverage new models and technology, and that's what the Yaala team is all about.
That's fascinating. So therefore it's also quite interesting because you've worked across a gamut of different businesses, not just in terms of the type of technology, and as you said, every time it's an iteration, it's a new generation. But I'm intrigued. I mean, what's it like in terms of the difference between the dynamics of working with and working for big companies versus smaller companies versus actually startups?
Yeah, I think the grass is always greener on the other side, right? Because when you're a small company, you're dreaming of scale. When you're in a big company, you're wishing you could be more flexible and get things done. They bring different things to the table. There's room, there's space in the industry for the whole spectrum. I think as I mentioned earlier, I do think a real change to the industry or the approach of startups has been at the advent of cloud, and because, again, not to repeat myself too much, but to be able to leapfrog and to become, to basically, if you have a SaaS solution and you get on an AWS platform or any platform out there, you're instantly global. And so I think that the incumbent advantage of large organizations has been challenged by cloud to a large extent. That being said, we are in a highly regulated industry, and you have to have a certain amount of scale to be ISO certified, SOC certified, to make sure that you're secure with your operation, that you can provide great SLAs 24/7, global, all of this, and that's not easy for smaller companies as well. So larger organizations, you do have that comfort factor, but I do think the pendulum has shifted more in the past 5 years to more competition and more more startups, or the ability for startups to be even more competitive. And it's great. I mean, on a personal level, to be working in a smaller organization is incredibly dynamic. Every not just every day is different, but to work with people that know that they can actually create change it just gives excitement to every day. I chuckle whenever I see a large organization that has an innovation department, or somebody that has innovation in their title. And I hope anybody listening, I don't take too much offense if that's you, but it's, when you're a smaller company, it's all about, you can't mandate innovation, right? But when you're a small organization, you get things done. You're living and breathing it every day, and you can't replicate that in a much larger organization where compensation structures aren't so directly aligned. Where maybe people are much more focused on annual bonuses and not taking a multi-year view. So I think that it's good for the industry, good for the financial markets to have a larger influx of smaller companies that provide that innovation, that provide, that are hungry and they're bringing things to the table, but they can be married with global infrastructure. And that's kind of where we're heading right now. And I think it's a very good thing for the industry.
It has to be said, I'm smirking here because you're talking, Mac, about the idea of chief innovation officers. And certainly what I've always noticed is they're always brought in to break all manner of glass ceilings, shake things up, do incredible things. And yet all bank chief innovation officers are essentially a white bloke with a beard wearing jeans, a roll neck sweater and sneakers. And it just seems quite incredible that this seems like ubiquity. They're totally different, but yet they all look exactly the same. If you shuffled them, I bet no bank would actually recognize who was their chief innovation officer. I mean, you could have a game show out of it where they could sort of blindfold people and say, right, take the blindfold off now. Is that your chief innovation officer? Because they all look exactly the same and speak identikit kind of bullshit, sort of bingo kind of slogans at all points in time.
Yeah, well, I couldn't possibly comment on that, but but I do think that the there's an opportunity for for organizations to bring in innovation. You got to work with the right partners, got to work with the right vendors, and frankly, some of the larger vendors are going to be talking innovation because it's great as a marketing story, but it's you got to look beyond the marketing. I'm going to stand up for a second and turn my lights on.
You're going to stand up for a moment, so I'll extemporize while we're sitting here talking with Mack Gill, delivering new Parish technology. Mack is just sorting out a slight electrical light impediment which he's having at the moment. It's interesting, we've been talking about cloud technology, but so far no one seems to have managed to get an FTTT onto the lamps in the office that can manage to keep them on. It's hopefully going to be working for you in a second, and I do believe that there's more illumination behind you, Mack. And yeah, I mean, it's really, really interesting, though. You talk about the dynamics of what companies can do. But at the same time, I mean, it's difficult when you're a very large public company because you are constrained. And in fact, you're always constrained to some degree or another by the system that you've written, because you instantly have that Clayton Christensen innovator's dilemma problem of trying to get rid of what you've already got and eat your code alive, et cetera, et cetera. And obviously that does make it much more exciting when you're a smaller company or a startup because you've got a lot of flexibility, I would presume.
Yeah, but definitely. But remember that, I mean, most startups do fail, right? I mean, that's just a fact. We all, the industry knows that, but it's a shockingly high number of startups that fail. So it is, you are taking risk going through that process. Again, I'm very fortunate with, we're not certainly not a startup at Torstone. And again, we had we talk about it, we've invested $175 million of R&D into this platform. And a lot of that came from, before we were an independent company. So we were very thankful to our, to the bank where we came from for that. And also for Yaala, we are way beyond that point, just given the clients and all of that. It's the first year or two is always very, very difficult. But look, it's not, I don't want to shoot down the opportunity for change. Yeah, and I will use the word innovation at large organizations, because again, when you have scale, when you have the network effect, and if it's well managed, you can accomplish a lot. But it requires, I think it requires really much a multi-year view, not this annual bonus and budget cycle, because especially in things like post-trade, there's a reason why regulation on T+1, for example, is looking out 2.5 years to the end of 2024. And frankly, if you ask me, I would bet that's not even giving the industry enough time to actually make this move. I think it's going to take another year on top of that. But we're in a part of the industry that requires multi-year planning, multi-year budgets. And so that's something that isn't always easy for a lot of organizations to get to manage, right? To manage their management, their teams, management incentives plans, multi-year budgeting, all of this stuff. So it's a different level, of innovation challenge. But of course, when you get it right at scale, it's absolutely tremendous. And again, I think the opportunities for every large organization, or frankly, even mid-sized and small financial institution over the next few years, is to look for efficiencies and adopt very aggressively new technology, because we talk, the regulatory changes, all these other things, but also let's not forget the economic cycle that we're going through, and who knows how long this one will last, right? It definitely has. It looks and feels like a unique cycle that we're going through, and everybody has that responsibility for efficiencies. So I think that's why I just see this, this convergence of trends coming together through 2023, 2024 that are going to drive a heck of a lot of change. So the status quo is not, especially in post-trade, where frankly, we have decades of status quo in most organizations. A lot of organizations have not changed their systems in literally decades, 30 years. You meet a lot of people that in this industry who've never migrated a back office system, a post-trade system, which is shocking. It's amazing, right? Because it's actually not that difficult. Certainly not in the modern age with with cloud technology and agile approach and APIs and all the things that newer platforms bring to the table. I can understand migrating from one legacy system to another legacy system, has been painful in the past, but things have changed. But you really have to educate people on obviously the benefits, but also why it's not, it's not the same risk as doing this, 15, 20 years ago.
Well, but you say that. At the same time, we started this conversation and I introduced by noting some of the comments about the ASX and the digital asset solution, which fundamentally hasn't been installed. And I mean, they've spent more money on that solution trying to bring it in than you've spent on R&D. And by the way, I mean, that's an incredible number, $175 million, but they've spent something like that actually in US dollars. They spent, what, 250 million Australian so far, something like that. There obviously are problems and issues when it comes to upgrading from old gen. And I mean, chess is a wonderful system, but it's very, very old. It's older than our careers, all the way to suddenly the new things. So, I mean, those are obviously huge pitfalls that can arise.
Yes, there are so many opinions on that project. It's a sensitive topic in many ways. I think what I'll say about that is that it's, when you're looking at step change in a measured way, that's something that I think is low risk. And I've been involved in many projects, both, in terms of market infrastructure back at Millennium, both our sell side here at Torstone. And when you're dealing with a measured step, that's something that can be managed and you know what you need to know. I think that project really was a two-step, right? It was going from a very old system into something that frankly hasn't totally matured yet, certainly in the use case in the context of market infrastructure. And I think there were a lot of aspirations. We all know that. Everybody in the industry, has been watching this for years now. And I can only applaud the vision. And certainly they had amazing ambition there. But it's when you're dealing with market infrastructure, things have to be done in a very measured way. And obviously it hasn't rolled out the way that it's been planned, and the costs have been huge. So I would not characterize, when I look at post-trade change, especially on the sell side, I wouldn't characterize it in the same way that of the kind of thing that ASX has done. Because again, we're not talking about going, and putting everything on DLT. That's not the use case. That's not, there's certain markets out there that it can be very interesting to do that, especially on the trading side. We talked about Ledger Edge, and they're rolling out very interesting market model in DLT. It's made for purpose, and there's a reason for that. But if you look at just the current state of legacy sell-side technology, there's so much to be done with existing contemporary technology. McKinsey just came out a while ago with a really great analysis from their perspective, saying that they thought that 45% of the financial markets in terms of technology and operations, could be modernized and could be transformed with existing technology. We're not talking about moving everything to DLT. And look, this is the 2023 soon. I think we all, a few years ago, a lot of people were drinking a lot of Kool-Aid, right? And it was technology looking for a rationale. And there are use cases, and that'll, but it's, horses for courses. And for most of the core, market infrastructure, either for exchanges or what have you, or for sell-side institutions, we just need efficient, modern, automated operations, whether or not that's in the cloud or it's in-house, whatever, but it has to be modernized. And we have to get rid of batch processing. It's absolutely, it's just a chain around this industry.
So bye-bye batch processing. We've got to get modern. That leads us to the final question with a few minutes left. Matt, Gill, where does the capital market revolution go next?
Well, I just bringing this together. I think that I haven't seen in my career such a convergence or a confluence of things coming together. We have the regulatory move with T+1, which, as I said earlier, is massive. It's bigger than most people think in terms of what the work that has to get done, the change that's going to drive. And again, not just in North America, but globally in the next couple of years. We have all the influence of crypto, and we didn't talk too much about crypto. It's incredibly interesting. It's real as a market, as an asset class. We handle at Torstone, we handle crypto. It's just another asset class for us. But it's, when we look at market participants having to provide crypto capabilities to their clients, that's something that is driving real change. When we look at the economic cycle, that we just talked about, and the need for cost and efficiencies over the next year, all these things coming together, to me, it just seems like this is, there's been more change in I think in the industry overall, but certainly in post-trade over the next the next couple of years than we've ever seen in the last 30. And so if you talk about capital market revolution, certainly from a post-trade perspective, I think there will be just massive change, and again, I think people are waking up to it. So it's a very exciting place to be, and it's great. I'm sure I think next year is going to be interesting. We're all going to be looking at your newsletter avidly, and I'm sure you'll be covering all the excitement in post trade, week by week.
I think it's absolutely enthralling what's going to be happening in post-trade, Mac. I totally agree with you. That's an incredible area with amazing opportunities. We will be covering it in Exchange Invest every day. If you want to get a free trial of that, DM us. We will be happy to add you to the list if you're interested, and join the cognoscenti of market structure at the Exchange of Information. Next week, we've got Christian Katz, Securitizing the Future. Christian, of course, a former chief executive of the Swiss exchange itself. That's going to be same place, same time. So therefore, 7 days from now. It only remains for me to say thank you very much to our guest this evening, Matt Gill, who's been most interesting, discussing all aspects of delivering Parish tech, from the buy side to the sell side, from large to small, across matching engines, and of course with all of these very interesting jobs out of Yaala Labs, and as well as Torstone and the whole Ledger Edge project, which I'm very, very excited about myself, because the bond market needs and has got huge opportunity for its own capital market revolution internally. Thank you very, very much, Les Calvert, Michael Grekoff, Marcus Ward. Thank you to our production team today. Beata's been in the background. Up front, we've had Mary, Natalie, and Jamil doing a fabulous job. My name's Patrick L. Young. I wish you a great week in life and markets. See you again for IPO-VID 82, same place, same time next week.